You're listening to Uranium Spotlight, brought to you by Purepoint Uranium Group, your exploration partner in the most prolific areas of Canada's Athabasca Basin. With a collaborative investment model on district-scale projects and validation from industry leaders Cameco, Orano, and ISO Energy, Purepoint is investing in Canada's uranium future. And now your host, Chris Frostad.
It's Tuesday, September 2nd, 2025, and this week on Uranium Spotlight, the spot edges higher while term holds at 80. Cameco trims 2025 output, spot tightens a thin market, Russia and Niger squeeze French supply, and NextGen extends shallow high grade at PCE. The uranium spot price closed last week at $75.90 a pound, nearly $2 higher than the week before. Activity picked up with 8 spot transactions as the market responded first to Kazatomprom's production guidance and then rallied further on Cameco's reduced McArthur River forecast. Year-to-date, spot volumes have now reached almost 32.7 million pounds, about 10% ahead of last year. Utilities have been unusually active, already securing more than 10 million pounds, almost double last year's pace. Traders and financial buyers have each added around 10 and 8 million pounds respectively, while producer purchases have dropped off sharply compared to 2024. Looking ahead, September through December is projected to bring 9 to 14 million pounds of additional activity, broadly in line with last year's final quarter. On the term side, activity was quiet last week with just a couple of smaller utility midterm awards booked. Formal requests remain limited, but off-market negotiations are continuing. Importantly, the long-term price indicator held steady at $80. That figure can be misleading since contracts often include escalations, floors, ceilings, and hybrid pricing mechanisms. Still, the persistence of $80 as a baseline level highlights the tightening fundamentals. With Cameco trimming 2025 production and Kazatomprom expected to announce deeper 2026 cuts, utilities may have little choice but to step into term contracting more aggressively, despite the narrow gap between spot and long-term levels. If you haven't already, be sure to subscribe to Uranium Spotlight podcast, available on your favorite podcast platform or on Purepoint Uranium's YouTube channel. Cameco has announced it will be cutting its 2025 uranium production forecast, and that's sending a clear signal to the market. The company had been guiding towards 18 million pounds of U3O8 for this year. That figure is now reduced to a range of 14 to 15 million pounds. The shortfall comes from development delays at the McArthur River mine, where slower than expected ground freezing and challenges transitioning into new mining zones have pushed back output. Cameco does have some relief from its Cigar Lake operation, which continues to perform strongly. Management believes Cigar Lake may offset up to 1 million pounds of the lost McArthur River output, but the reality is that the company will still produce materially less uranium in 2025 than originally planned. This comes as global supply pressures are already mounting. Kazatomprom, the world's largest uranium producer, recently announced it will reduce production in 2026 by about 10%, equivalent to roughly 8 million pounds of U3O8, or about 5% of global primary supply. These back-to-back cuts from the sector's dominant players highlight how fragile the production chain remains even before considering new demand drivers. On the demand side, nuclear utilities are working to secure fuel for reactor fleets that are running harder and longer. Many companies are extending plant lifespans, and dozens of new reactors are under construction. At the same time, the energy conversation is shifting. The rapid growth of data centers and artificial intelligence is fueling demand for carbon-free baseload power. Nuclear is increasingly being positioned as central to that equation, which reinforces the need for reliable uranium supply. For investors, there are 2 key takeaways. Near term, Cameco's reduction tightens availability just as utilities and intermediaries navigate their procurement schedules. That tension often shows up first in the spot market, where prices today are sitting in the mid-70s. But it's the contract market that ultimately matters for nuclear utilities, and the current backdrop gives producers more leverage in long-term negotiations. Medium-term, Kazatomprom's planned 2026 pullback adds another layer of uncertainty, raising the floor for incentive pricing. In short, Cameco's update isn't just a company issue. It's another reminder that supply is vulnerable while demand remains robust. For investors, the setup continues to point towards stronger uranium prices and the potential for renewed interest in well-positioned uranium equities. Sprott Physical Uranium Trust has added another 50,000 pounds of U3O8 from the spot market, bringing its third quarter purchases to 1.2 million pounds. Total holdings now stand at 68.6 million pounds of uranium, valued at about $5.2 billion. That represents material equal to about 35% of last year's global reactor demand. This quarter's buying pace is Sprott's strongest since the second quarter of 2024. Almost all of its uranium has come from the spot market, which remains thinly traded. Last year, Sprott's aggressive activity was one of the forces that pushed spot prices above $100 a pound. It's worth remembering that only a small portion of uranium transactions occur in the spot market. Roughly 90 to 95% of uranium is sold through long-term contracts signed by utilities who usually secure several years of fuel in advance. Spot transactions are typically driven by financial buyers like Sprott, while utilities use it only occasionally to fill intermediate gaps in supply. That balance is starting to change. Utility demand is rising just as the two largest producers, Cameco and Kazatomprom, are reducing output. This points to increasing tension between financial stockpiling and real fuel requirements. For investors, the takeaway is clear. Spot market volatility is not going away, and utilities will be under pressure to contract at higher prices. Financial demand may have sparked the rally, but utility demand will determine how high and how long it runs. The BBC reports that Russia has effectively outmaneuvered France by cutting off its uranium supply from Niger and then solidifying ties by offering to build Niger's first reactor. On top of that, Niger is considering selling roughly 3 million pounds of uranium that Orano left behind when its mines were seized by the military junta. That junta took power in a 2023 coup supported by Russia, Mali, and Burkina Faso, and opposed by the United States, its allies, and neighboring states like Nigeria and Benin. The impact on France and the EU is significant. About 20% of France's uranium supply and 25% of the EU's, based on 2023 figures, has effectively been cut off, and this looks permanent. Orano has been working to ramp up production in Kazakhstan, Mongolia, and Canada, but Kazakhstan remains a close Kremlin ally, and Mongolia has leaned towards Moscow as well. That leaves Canada, but Canadian mines alone cannot cover the fuel needs of France's 60-plus reactors. For investors, this highlights a structural shift in uranium markets. Western utilities now face fewer secure options for supply, reinforcing the long-term need to diversify away from geopolitically risky sources. It adds another layer of pressure on Western-friendly production from Canada to Australia and strengthens the investment case for exploration and development companies positioned in those regions. NextGen has reported more strong drill results from its Patterson Corridor East project, only 3.5 kilometers from Arrow. The highlight, step-out holes RK25-254 and RK25-256, each intersected over 2 meters of off-scale mineralization exceeding 61,000 counts per second. Importantly, these hits were 51 and 119 meters away from last year's standout hole, which returned 15 meters, grading nearly 16% U3O8. Other holes also delivered broad mineralized intervals, 20.5 meters in RK25-246, 18 meters in RK25-247, and nearly 20 meters in RK25-254. Several intervals included high-grade zones above 10,000 counts per second, confirming continuity of strong mineralization across the system. What makes this especially noteworthy is the shallow depth. RK25-254 encountered massive uranium at just 454 meters. That's among the shallowest high-grade intersections NextGen has ever drilled. The mineralization is hosted entirely in competent basement rock, similar to Arrow, and remains open in multiple directions, both up-dip and at depth. Since its discovery in early 2024, PCE has delivered 79 drill holes, with 48 showing mineralization, 34 of those high-grade, and 14 containing off-scale hits. NextGen has drilled roughly half of its 43,000-meter 2025 program, leaving plenty of news flow ahead. For investors, these results reinforce NextGen's position as the sector's leading developer with a pipeline beyond Arrow. The consistency, grade, and shallow depth at PCE suggests real potential for a second world-class deposit, something that could reshape the supply outlook and keep institutional focus firmly on NextGen. And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to delivering the latest news and events shaping the uranium fuel market and its critical role in the global energy landscape. Brought to you by Purepoint Uranium Group. Purepoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with industry leaders. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next Tuesday for Uranium Spotlight.